Welcome to the Markowitz, Fenelon and Bank, LLP video blog.
Entity selection is important because of the tax laws. You have to analyze the client's individual circumstance and then run the numbers and make sure that the choice of entity makes the most sense. So one of the pros of LLCs are the ability to deduct losses based on at-risk amounts. Another pro of an LLC operating as a partnership is the ability to make distributions that are disproportionate to ownership percentage. You are pretty much allowed to do whatever you want distribution-wise and disregard ownership percentage. Some of the disadvantages of an LLC operating as a partnership would be that all of your net income is subject to income tax and self-employment tax. So, that could be a disadvantage if you're showing a lot of net income that's subject to both of those taxes. And on the contrary, in an S corporation environment, that could be a potential benefit, because in an S corp environment, the shareholder or owner can take his or her salary, and then the net income of the S corporation is not subject to self-employment tax. So you can escape some of the taxation for self-employment tax purposes. But the caveat is IRS wants to make sure that you're paying yourself reasonable compensation for the level of services that you're providing to your S corporation. So the con of an S corporation could certainly be the proportionate distributions. So if you're taking distributions of income, they have to be directly proportionate to the ownership in that S corporation. So that could pose a problem if you're trying to make disproportionate distributions. You just can't do it. In the C corporation environment, you're basically afforded the same type of legal protections as an S corporation or an LLC, but with a C corp environment, you're taxed at the corporate level, where LLC partnerships and S corporations all pass through income to the individual shareholder. So the C Corp is a taxable entity. One of the benefits of that, and this just changed in the 2018 tax law, is C corporations are now at this point taxed at a flat 21%. If you're the type of C corporation that is very capital intensive, where you have to make big investments in equipment, and inventories and have that big type of CapEx budget, you need to show net income at the corporate level. Having a flat 21% is very nice. You know what the tax rate is. It's a flat 21%. There's no more graduated tax rates jumping up to 34 or 39%. So it's certainly more reasonable to have a flat 21% tax rate if those needs are to be met at a lowest tax cost possible. A disadvantage of the C corporation is it is a taxable entity at the taxable level. Therefore, if you do leave net income in the C corp and you eventually want to pull it out to yourself as shareholder or some other compensation, it's going to be taxed a second time. So you could conceivably have net income taxed at the C Corp level, then take a dividend, which will be taxed at your individual level. It would get or could get preferential dividend tax rate treatment. So it would be at a lower rate, but it is a double level of taxation potentially. So again, it's based on the needs of your individual company and circumstance, whether it makes sense to be a C corporation or an S corporation.
Thank you for watching. If you enjoyed this video, we invite you to subscribe to our YouTube channel.